Good afternoon, everybody. Thank you so much for joining us. My name is George Dyer. I'm the Executive Director of the Intentional Endowments Network, and we are very excited about today's topic, looking at sustainable investing options in higher education retirement plans. A few of the basic logistics: all of our attendees are on mute, and we encourage you throughout this program to submit questions through the Q&A windows, and we will look to address as many of those by the panelists at the end. And this webinar will be recorded and available after the session, so please do check back and feel free to share it. Next slide, Hannah. For those of you who are not familiar with the Intentional Endowments Network, just briefly, we are a nonprofit peer learning network, and we support endowments of colleges and universities and other nonprofits in looking at ways to align their investments with their institutional mission and sustainability goals. Next slide. There are many ways to engage with the network. We have a suite of resources on our website. We hold virtual and in-person events. We've got working groups and initiatives. And as you can see here, a roadmap for endowments in terms of navigating these processes. So we encourage you to visit our website and learn more and engage with the network. Next slide. And finally, this webinar is the first in a series of webinars on this retirements initiative. So we encourage you to join subsequent webinars. We'll be touching on many of these topics today, but going deeper in some of these following webinars. So please do check back for exact dates when these become available and join us in continuing this important conversation. And with that, I'm going to hand it over to Chris Walker, who is leading this initiative for us, to give us a little background and get us into the conversation. So Chris.
Thank you, George. Welcome, everyone. And really happy that you can join us. We have a great audience for this event, and we really look forward to introducing our project here. I'm going to provide a quick overview of what we're doing with the initiative, and then we're going to turn it over to Mike Florio, who's a trustee at Northland College, and he's going to provide kind of an institutional experience. So basically what Northland College has done and been thinking about in relation to ESG and the retirement plans. And then we want to turn it over to the experts on our panel from Natixis and Schroders and Mercer, who will be providing, an overview of what they're seeing in the marketplace, and then also what the opportunities are and how others have been potentially looking to integrate ESG into their retirement plans. Next slide, please. So this is, if anybody who's seen me speak over the last few years know that this has been a pet issue of mine, that I've noticed that there is a huge potential in the retirement plans of institutions, particularly if you think about the institutions out of the vanguard, members of IEN, who have taken initiatives around sustainability. And yet somehow when the retirement plans are developed, they do not incorporate or have not looked to incorporate ESG options for their employees. And yet arguably their employees potentially would be highly motivated. The impact potential is huge, right? Globally, pension funds are $40 trillion and assets under management in 403Bs are $1 trillion. And I think there, if you look at what are the issues that are potentially going to affect employees' interest in looking at their retirement plans, maybe afresh post the COVID lockdown, is obviously COVID has had a big impact on the stock markets, fossil fuel, and its impact on the economy. It's also the economics of fossil fuel have changed dramatically. And then if you look at on the demographics, more people are needing to or planning to retire. There will be a great transfer of wealth between retirees and younger generation, who generally are a little more inclined on ESG issues. And then if you look at what climate change impacts and what the pandemic, I think, has shown us is that society has to band together in a sense to address these issues, and climate will be the ultimate opportunity or need to band together. Next slide, please. So why should IEN members participate in this initiative? It's a blind spot, as I mentioned, that a lot of the organizations that are arguably the vanguard institutions in the higher ed space, for instance, but somehow when it comes to the investment options given to their own employees, there's a missing element there. You know, these institutions are mission and value orientated. And so you would think that these would be precisely the institutions that should be looking at opportunities. And I think it's just been something that has been forgotten. So certainly more from a kind of a negligence point of view in the sense of people not thinking about it rather than anything that has been conscious. But also, I think post the epidemic, you know, there is going to be this values orientation, I think, on the part of people, where people are going to be looking as to where have I been invested, why am I invested in these things, and potentially like to have things that maybe more mirror their values and the institution's values that they work for. I also think, you know, just thinking for this impact point of view, the 4,000 colleges and universities in North America represent such a sizable pool of assets. I mentioned the 1 trillion 403Bs. There's some subset of that is for the colleges and universities that is potentially huge and potentially impactful. Next slide. So the purpose of this initiative is really to educate and inform advocates and plan sponsors on the potential for ESG. So how do we help you think about this, help overcome any barriers that you may be facing, and then help you also to engage your workforce and think about how the workforce potentially might view this. And then potentially also to close any inconsistencies in your sustainability strategies. So our objectives is that we will identify the barriers. We've started off with a survey of 2,000 institutions, and we have been collecting the responses, which have started to talk about what has been some of the issues and barriers facing the institutions, but as well as, you know, what are some of the kind of impediments that we need to overcome? How do we overcome fiduciary duty? How do we overcome performance risk? How do we overcome what employees want to see? And how do we address that? Next slide, please. So this project is modeled after a predecessor project that was run that I was involved with at the WBCSD, the World Business Council for Sustainable Development, and that involved corporates. And it was a similar issue in that these were arguably the vanguard companies in the corporate sustainability space. And yet, when it came to looking at their retirement plans, there was a huge gap in the sustainability strategies deployed. And we worked with a number of coalition partners, including the Texas and Mercer, who are involved in this, as well as the PRI. And we developed some approaches and some toolkits that potentially were helpful in helping these companies think about how do they go about implementing some changes in their retirement plan. Next slide. So for this project, our steering committee is made up of ASU, University of British Columbia, University of New Hampshire, Northland College, and the College of Charleston, as well as the Texas and Schroders as asset managers and Mercer as our advisor. PRI is also involved here. We are seeking institutions to participate in this initiative, and what we're hoping after this call that a number of institutions say, yes, this is something we'd like to participate in. There is no charge to participate on the part of the institutions. Next slide. And what we're hoping for the outputs for the next year of this project is to develop what we call toolkits. This was very similar to what we did in the ARA project. Which is an initial toolkit is probably why you would want to do this and then how you would go about implementing. So how do you overcome some of the barriers and issues that will be raised? And then we will be doing, as George mentioned, a planned series of webinars. The next one is fiduciary duty that will be likely at the end of June. And we hope to uncover, you could say, some of the myths around fiduciary duty and what people perceive as preventing institutions from implementing. And then we will also, hopefully, once we go back to kind of a more normal schedule, series of events with a wrap up of this project, potentially at the higher education event of IEN in February of next year. And then please keep an eye out for thought leadership and articles where we want to delve into some real specific issues around default options, for instance, attracting employee participation and in the education of employees on these issues. Next slide. So I'd like to turn it over to Mike and to give us some insights into an institutional experience of Northland College. Mike.
Thank you, Chris. I'm a trustee of Northland College, in a four-year liberal arts environmental school located on the shores of Lake Superior in Ashland, Wisconsin. Northland is, I believe, 130 years old now and is widely held out there in the independent press as one of the places you might consider if you were a student interested in sustainability and environmental causes. We have a student population of roughly 600, and most of them attend Northland with an environmental sustainability bent. We're all familiar with Greta Thunberg, and the students that attend Northland are much like her. Northland went through the fossil-free divestiture about 3 years ago and completed its divestiture only recently. And that's the perspective that our professors and students come from. Yet, I'm not so sure that those same professors are taking full advantage of the investment opportunities to go fossil free and ESG with an ESG consideration as well. Northland is part of a consortium of Wisconsin colleges and universities known as WACU, the Wisconsin Association of Independent Colleges and Universities. Collectively, they have a 403B, which offers participants one of two ways to get involved in ESG. One is one of the individual offerings in the plan, a Vanguard fund, the FTSE Social Index Fund, Admiral Series. And it's really not a one-size-fit-all, but that's your option if you want, if you don't want to think about it. The other option, which I find interesting, is essentially create your own sleeve of investments, and your limitations are virtually limitless. You pick and choose, and for $50, you create your own account, and it must be a mutual fund open to the public. You need at least $2,000 of an initial investment to invest in the fund, and that's about it. You're kind of left to your own devices with respect to choosing your investments, but these are educated people, and with a little homework, you can make that happen. The thing that I find interesting, and this is just speculation on my part, I don't know the numbers, but I don't really think there are very many people who are taking full advantage of the ESG options available to them. And in my opinion, I think it's just simply a matter of, knowledge base. While these folks, 80% of the curriculum at Northland includes sustainability, I'm not so sure these folks, while they went to school and are very smart, they understand what they teach. I don't know that they were actually taught what to do with the money they make once they make it. And therein lies our charge. And with that, I'll turn the program back over to Chris.
Thank you, Mike. So that's interesting that you think that there is a real knowledge, or you could say insight gap, as to the impact potentially people could have with their own money, even though they are quite well-versed in sustainability issues. So I'd like to turn it over to our experts panel, and I'm going to start off with Jim Roach from the Texas. And Jim, please take it away.
Thanks, Chris. Good afternoon, everyone. My name is Jim Roach. I'm a Senior Vice President at Natixis Investment Managers. At Natixis, we're a $1 trillion global asset management company. We're the 15th largest in the world. We're big, we're global, and we do many, many things. But one of the things that I'm really excited about what we've done is we've created the industry's first and only sustainable target date fund to help companies, universities, and their employees align their investments with their values. And today I'm going to talk about why you should consider ESG investments. But before that, I want to start off with a few facts and stats to set the framework for the conversation. So over the past 2.5 years, my job has been to help plan sponsors at any type of ESG investments, environmental, social, governance investing, to their retirement plan. And I know Will's going to talk a lot about today how to do that, but I want to emphasize the point of you really have to understand the process that the companies or universities go through on how you want to add it, and more importantly, working with the plan sponsors from the university. And a plan sponsor is someone that's in charge of the university or company 401k plan. They have a fiduciary duty, and their fiduciary duties put the economic interest of the participant above all else. They cannot invest for values. So what's more important is you have to talk their language, you have to talk their process, and understanding that. So if you agree with a lot of things we say today, I know we're going to talk further at another webinar, but understanding that fiduciary duty and how to work with these individuals is the path of least resistance. So the second point I want to talk about is the size of the defined contribution space in the United States. So the defined contribution space is $9 trillion. And when I say defined contribution, that's where you, the participant, get to pick what type of investment you want to help you to save for retirement. McKinsey & Company has stated that by the year 2022, the defined contribution space is going to grow to $11.5 trillion. Now that is a huge growth, but in today's world, of this $9 trillion, less than 1% of the assets in the defined contribution space where you, the participant, gets to pick, actually it's 0.03% of that is ESG investing. That is not enough. We have to do a lot more. There's a lot more we can do. And the more money that goes into ESG funds, the more we can hold companies accountable to do the right thing in treating the resources of our world and our employees better. There are lots of studies that are showing that the good businesses are good for business. Companies that treat their employees better, have policies for the environment, and have diverse boards, just to name a few, are performing better in their stock price. ESG is not just a feel-good story, it's a performance driver, which allows fiduciaries to add ESG investments into the DC plan. So, and before I get into the slides, my third point is just things to think about. Did you know that a passive investment in the S&P 500, the 500 largest stocks in the US and the most broadly used index in the world, that passive investment, you're going to warm the world by 4.3 degrees. Just mean your investment there, you're going to warm it by 4.3 degrees Celsius. I don't think that aligns with many of the universities or the participants or what they believe in. And people need to know that there are better options out there. And what I want you to think about as we all three of the panelists talk, what do you own and why? So let's get into the why. And if you can go to the first slide, the future of work. Yep. Right there. So the future of work. So Natixis has done a number of white papers that I'm happy to share with anyone on this call with the future of work. And go to the next slide, please. So one of the first things we talk about is an economy in transition. Now, many, many generations ago, time has changed from the hunters and gatherers to the industrial age, to the information age, to the connection, to the social age, the connection age that we have. When we evaluate stocks and bonds as asset managers, we're evaluating them with the old metrics of looking at the industrial age and the information age. We're not taking into account that time has changed, the economy has changed, and companies have changed. So when you think about ESG, environmental, social, governance investing, all we are doing, we are asking better questions to find better valuations for stocks and bonds, identifying the risks, and we're doing that through non-financial material information. So I sometimes get confused on what the whole concern is about ESG and sustainable investing when all you're given is us asset managers the ability to ask better questions, to do more work, and better evaluate the stocks and bonds that we're going to buy on behalf of the participants to eliminate the downside risk and find potential upside performance by just asking questions. We've determined that when we ask questions about the environment, social issues, and governance, that we can get to the heart of a company, including the material financial information. Next slide, please. So two things I want to show here, and if you look on the left side, beyond wages, and happy to send this piece to anybody, but I think universities would like to see this, as it talks about the rising cost of tuition over the last 2 decades, but it shows early career salaries and minimum wage has barely moved over those time, which puts a lot of our recent graduates and millennials and Gen Zers in a tough spot because they have debt to pay, but they're not making the money up front. If you look on the right-hand side, a 4 to 1 margin, a margin of 4 to 1, employers are saying they're willing to take less money for more robust benefits. And of course that's health, but that's also retirement. It's also having companies and universities help them retire, help them save for retirement. And you're gonna hear Will and others talk about, you cannot replace time in a 401k plan. So getting people invested often and early and being a part of the 401k package is, part of the benefits package is important, but then also getting them excited about investing in their retirement plan. Next slide, please. One more. So how do we get them excited? And I think you get them excited. People are looking for sustainable or ESG investments to invest in. So Natixis has surveyed defined contribution participants over the last number of years, and here's some of the stats that we've come up with. So 75% of investors would like their investments to reflect their personal values. 69% believe it's important to make a positive social impact through their investments. 84% believe it's important to be invested in companies that are ethically run. And 60% would like to see more socially responsible investments in the retirement plan. Next slide, please. Millennials, and even Gen Zers, but millennials stand out more than most. And I know I mentioned them a few minutes ago, but did you know by the year 2025, 75% of the workforce will be millennials? They're going to be demanding this anyway. They're demanding it now, but when they have a majority, they're going to be demanding even more, and they'll be the ones that are making the decisions. And we've also found that 66% of millennials would likely increase their retirement plan contributions if they knew their investments were doing social good. So, one idea that we've been showing the case study is we had a company add our sustainable target date fund in the summer of 2018. And they're a research company. So I got a phone call from the executive at the end of the year, and they said that, that they wanted to share some stats with us. That when they added our sustainable investing, we weren't even QDIA. They just added us to the option. That the company, at 6 months later, they found that the contribution rate, the participation rate from the company went from 57% to 100% over a 6-month period, and was not an auto re-enroll, that everyone elected into the retirement plan. Monthly contributions increased 230%. And in every interview they have as a growing company, they were small, but they're growing. They said that they talk about this as a top 3 topic when you talk about benefits. Of course, health is number 1, but retirement plan and ESG options were in there. And they said that they walked the talk, and this did not cost them any money to add sustainable options to their plan, but it was something that their people wanted and the companies believed in. Next slide, please. So here's just a quick example. When I talked about material, non-financial information that we're seeking, this is some of the things that we look at. So you see the sectors on the left with the risk and the opportunity. I'm not going to read this chart, but let me rephrase some of the words for you so you get a better understanding. Risk is potential loss of capital. Think of that. So we're going to ask questions and say, what is the potential loss of capital for our participants if we buy this investment? Or opportunities is potential growth. Remember, these are non-financial numbers, but we think these are extremely important to that show up in the stock price or the bond price. Okay, next slide. And one more. So in conclusion, the future of work, attracting and retaining talent, the world is changing. And what's important, it's even changed over the last 2.5 months, but companies, universities want to know, how do they attract and retain the best talent? Investors, particularly millennials, are demanding this investment, and they want this investment in their 401k. Educational institutions, they own a large part of ESG assets. Now, in the endowment and foundation, my question is, if it's good enough for your endowment and foundation, why isn't it good enough for your own personal retirement savings plan? I think that it should be. And then plans with growing millennial populations can benefit, especially universities and other companies, adding responsible investments to their plan. So I'll throw it back over to Chris.
Thanks, Jim. Some great points there, and hopefully this initiative helps move the needle on that 0.03% of ESG in the $9 trillion in DC plans. So our next up is Sarah Branton Hughes from Schroders. Sarah.
Great, thank you. Hello, everybody. Thank you for dialing in today. My name is Sarah Branton Hughes. I'm the head of sustainability for North America at Schroders. Schroders is a global asset management firm with over a 200-year history and $600 billion in assets under management. We have over 5,000 employees operating across 27 countries globally. Sustainability is embedded in both our investment processes as well as our corporate culture, and we have been in the field of sustainable investing for over 20 years. Jim hit on some of the points in his presentation as well, but we really are at that perfect storm for sustainable investing. We're seeing accelerating change. So the average tenure of a company on the S&P has dropped from 50 years to under 15 years in the last 5 decades. And at the same time, the amount of intangibles on a company's balance sheet, so the amount of R&D, their amount of patents, has grown from 13% to over 87%. We're seeing increasing regulatory scrutiny, maybe not here in the US, we're seeing pockets of it on a city and a state level. However, we're seeing a broad regulatory regime in Europe that will, over time, there's a high likelihood we'll see the same happen over here. And these are long-term, these systemic trends are long-term global challenges, whether it's climate change, whether it's income inequality, whether it is pandemics, which we're experiencing right now. These are all going to take not only public capital, government capital, but they're going to require financing and private capital to solve. And why are all of you here today? Because you're seeing increasing pressure, whether that be pressure from your faculty, from your student groups, from your alumni. You're seeing increasing pressure, and Jim hit the head on Jim said it great. If it's good enough for your endowment, then why isn't it good enough for your retirement plan? And just an add-on, Schroders also runs their own global investor survey every year, and we have seen very similar trends to Natixis on millennials really driving this. However, this was the first year in 2019 where we have seen Gen Z overcome millennials in their desire to have sustainable investing options. So we are really seeing a shift change. And I'll go through why I think right now we are at that perfect storm, what we mean by sustainable investing, really dive into that. And how some of these issues around performance, potential performance, and fiduciary duty may be understood and or have this crisis has subsided some concerns around performance. So next slide, please. So there's a broad spectrum of sustainability and ESG, and much like Natixis, Schroders takes the view on materiality and really focusing on how a company is managing all of its stakeholders, whether that be the environment, their employees, the regulators. So really looking at across the stakeholder base. And we're, as an asset manager, we're focused primarily on the left-hand side on the financial benefits of ESG and sustainable investing. So much of our product spectrum, and when we speak about it, we're focused on ESG integration. So systematically incorporating ESG throughout your investment process and a commitment to active ownership and engagement. And we truly believe if you take into account these long-term trends, and many of us, particularly in the 401k and DC space have a very long time horizon. You take into account these long-term trends, it will lead to better long-term risk-adjusted returns for our clients. One part I want to focus on is the button in the middle is screened. So Chris had mentioned the IEN survey that we had come out. The majority of the respondents back had said that they had had a screened strategy on their platform. When both Natixis and Schroders, I don't want to speak for Natixis, but I'm pretty sure this is accurate. When we both talk about sustainable and ESG investing, we're talking about an inclusionary approach to it, not an exclusionary approach. So we may have screens on some of our strategies, but we've done a lot of work on screening here at Schroders, and we've seen that it introduces factor biases into your portfolio that we believe that active investing can overcome, even if we do have a screened strategy on it. So going beyond that passive exclusionary approach. So how can ESG matter? We think it really matters in 3 ways. A pickup in sustainable growth. So identifying those investments that really have that long-term sustainability, looking out 5, 7, 10 years when we're making investments. So these are best-in-class investments. They're high-quality companies that have a business model that is sustainable over time and high durability to their cash flows. Sustainability can also help you avoid high-risk companies. So corporate scandal and fraud can destruct corporate value. We all know it. We've all seen it. But some people say, well, how can you anticipate something like a BP can happen? When you're an active owner and you're really engaging with your investments, well, we can't sit there and anticipate that PG&E is going to cause all those wildfires and go bankrupt. We can't anticipate BP. We can't anticipate Wells Fargo. But what we can say is there tends to be a tendency where there's smoke, there's fire. So we're working with these management teams, understanding how they're engaging, how they're disclosing. And we have teams here that are professionals. So it helps us to avoid those high risk companies that can really destruct value. And then engagement is not just about avoiding high risk companies. It's also about working with those companies and turning them around and unlocking that shareholder value. So historically, you've seen underperformance in many passive ESG options, either because they're screened or they're tied to a third-party rating. Third-party ratings are not all bad. They serve their purpose. However, ratings are inherently backward-looking. So you would see all of the banks going into the 2008 crisis being AAA rated. The scandal would come out, the performance would drop, they'd get kicked out of the index, but you would catch none of that up performance when management has really come in, boards are paying attention, there's oversight, there's change. So you miss that up gap in performance by the time they're brought back into the index. As active managers, we can really work with these companies and catch that up performance by engaging with them, making sure they have the proper policies and procedures in place to help sustain outperformance over time. Next slide, please. So again, we often get that performance question, a lot of it due to historical ESG or sustainability, or at the time, socially responsible investment funds, really being looked at from a screened basis. This is a third-party study done by Morgan Stanley when they looked at the performance of their mutual funds on their Investing with Impact platform versus their traditional funds from a very long time period, from 2004 to 2018. And the main findings in this were that there were no consistent and statistically significant difference in the total returns over time between sustainable or ESG funds and mainstream returns. But what they did find that in periods of market volatility, sustainable funds had a 20% smaller downside deviation than traditional funds. And why is this important? Because if you think about how compounding works and compounding returns over time, and that's what we're all looking to do in our DC plan, if you're down 50, you have to be up 100 to make your principal back. So if you compound those returns over time, it is really important if you cut off some of the left tail, the downdraft of the return distribution. Next slide, please. So how has this worked in the market downturn? And I mentioned this before, and I think we're in a period of time where this market downturn is coming a proof point for people to understand that sustainable funds are not, I've heard it many times, a bull market luxury. So the stock market's been up for 10 years. It's a nice to have sustainable. No, no, no. It's what this has proved during this time and during the market downturns is that the top ranked sustainable companies are outperforming the broader US market. Now, Chris had talked on seeing fossil fuel companies and the dynamics of that have completely changed. But also, if you look at this, it's not just a function of sector and size. So it's not just a function of removing the fossil fuel companies. If you look at this on a sector relative basis, sustainable companies have outperformed. And companies with lower ESG scores have seen larger earnings per share cuts. So they have underperformed over time. So this is critical evidence. And we've also seen somewhat in the US, but a lot out of Europe, that flows into sustainable funds have held up well throughout the crisis. So I really feel that we're at a place in time where we're going to continue to see this pressure build up due to this changing dynamics that we're seeing right now. We're all reading about issues within the supply chain and how you're handling your employees. People are going to want to know not just the companies. It's not just about how much money you make. It's also about how you make it. And people are going to question that in their investment portfolios. We're going to continue to see increased regulation globally, and we've seen pockets of it here in the US, whether that be in states like California, states like Illinois. And we're also going to see, coming out of this pandemic, increasing pressure from all of our stakeholders globally. So with that, I pass it over to Chris.
Thank you, Sarah. I love that line. ESG is no longer just a bull market luxury. I think that's great. Will, so our next speaker is Will Rao from Mercer.
Fantastic. Thanks, Chris. And good afternoon, everybody. Thanks so much for joining us. We're all delighted to be on this panel and hopefully bringing you some valuable information. This is a really exciting initiative that we're endeavoring on right now as it relates to these sustainable retirement plans, which is a core competency of our work at Mercer. So I work for Mercer's responsible investing team, which staffs 18 full-time employees globally. And full-time, we're working on responsible investment matters with clients of all types, including endowments, foundations, and last but not least, defined contribution plans. So both on the corporate side, as well as on the non-for-profit side. And if we start on the first page here, please. It's a perfect segue into this page right here, which really shows an investor snapshot. And I give credit to Jim and Sarah for framing this discussion very well in terms of kind of the why responsible investment? Why does this make sense, particularly now in a market environment like we've seen, where these sustainable funds, the thesis historically has been, that they offer an element of downside protection. And, I think it's been difficult to test these, as Sarah referenced, because, we've just seen a bull market and it's saying, well, in periods of volatility, how will these actually end up outperforming? And there's some great case studies out on the web right now just around how sustainable funds have outperformed during this market environment. And so with that framing, I think what could be valuable just in the context of this initiative is, well, broadly speaking, where are investors? Where are institutional investors that, Mercer works with and that Jim and Sarah work with as well? Where do they stand? Where do they rank in terms of their integration of responsible investment? It probably comes as no surprise to many of you that endowments and foundations really rank at the top here. Now, maybe I should caveat this list by saying I'm sure that there may be statistics out there that could differ from the list that we're showing here. Take it as an illustrative example of what may be out there. But foundations in particular, right, oftentimes formed with a mission in mind. So naturally are mission driven. And what we hear a lot from foundations is this idea of impact investing. So being able to really target and align what is the value of the values of your foundation. How do you make a really targeted impact with your investment that would align with the intention of your foundation? University endowments are next, and this is an interesting one, very relevant to this group that's on the line today, as I know. But what we found in working with our university endowments is that there's an increasing interest in being able to align an endowment portfolio with basically the objectives, the goals, the mission, and really the values of the university and the institution at hand. So oftentimes what we're seeing is that there's a collaborative effort between basically those who run the university and those who run the endowment, and being able to get a perspective from each side and bridge that gap of communication between the two can be invaluable, and has led to many university endowments adopting RI policies and more increasingly understanding their portfolio through a responsible investment lens. There are a few more institutional investors down the line. I'll go through a couple of these before getting to my next page here, which really says, okay, now we understand the lineup. How do we do this? But from a family office wealth management standpoint, you know, what we're really looking at here, I know that there are some family office experts on the line who could certainly speak to this, but at the end of the day, you're really getting very close to the individual here. You're getting very close to the retail side. And oftentimes the individual does want to align their personal values with their investments, but it's difficult to do that in the context of a defined contribution plan or of the public pension plan that they may be reaping benefits from. On that note, defined benefit and public plans, what we've seen in working with them is that, you know, there's a good amount of integration here. At the end of the day, a lot of what drives these asset owners is their reputational risk. And oftentimes what they're looking at is how can we protect our reputation? And I saw in the Q&A, there was, you know, reference to ExxonMobil, you know, so they're looking at this from a perspective of how can we ensure that we're not investing in something that would be harmful or seen as harmful by our beneficiaries. Insurers as well, you know, there's the principles for responsible insurers, and also what's driving insurers is really a long-term, I mean, most of these are long-term in nature, but really a long-term strategy. And when we're talking about long-termism, what you're talking about is sustainability, the ability to exist in perpetuity, and therefore, you know, incorporating ESG does make sense. And so then we get to defined contribution. And so we can break this out between corporate plan sponsors and non-corporate plan sponsors or not-for-profit plan sponsors. And as plan sponsor, the institution has laid out, in the 403B space, we've seen a good amount more integration than on the corporate side. So as you see there with the green box, approximately 32% of plans, so retirement plans in the 403B space or the not-for-profit space currently offer an RI option, which is put in parallel against this next level, which is really all defined contribution plans, including corporate plan sponsors. In our experience supporting corporate plan sponsors in integrating responsible investment, one of the biggest you know, impediments that we've seen, as Jim and as Chris mentioned, is really this idea around fiduciary duty and aligning with their duty in the ERISA realm. So if we move to the next page, that's really a broad overview, and we say, okay, we now understand the why. Why is it important and why is it relevant? Even in today's kind of markets, we then understand what does the current landscape look like And now from the perspective of a plan sponsor, from the perspective of a higher education retirement plan, how can you actually put this into practice? And how can you put it into practice from a fiduciary standpoint, ensuring that you fulfill that fiduciary obligation that you have in putting together a plan that is appropriate for your plan sponsors. So, first and foremost, what we have is basically this idea of assessing your existing ESG resources. So what's out there? Doing things exactly like Jim and Sarah just helped us with, which is basic education. Lean on your asset managers, lean on investment consultants to understand and inform your board as to what does all of this mean. That's really the first step, which then can allow you to understand what are the beliefs that you're really trying to align your plan with, that then can flow into your governing documents. A lot of this is documentation, checking the box, ensuring that you're doing the right thing as you continue to move through this process of integrating responsible investment, really making sure that you're documenting the reasons why you're doing it, the reasons why it is economically viable and sensible. And then you can finally move into this actual implementation and process phase. So, evaluate your current investment managers. What do they look like from an ESG standpoint? Are there maybe alternatives that have maybe a higher ESG profile in terms of their investment process? And what will that do to your portfolio? What are the portfolio implications? Sarah spoke about the fact that, if you introduce this idea of SRI, of screening, what does that do to an investment strategy? And is that what you want to be doing to allow your participants to invest in? And then last but not least, once you've incorporated this into your portfolio, how do you adequately communicate this with your plan sponsors, which can be a fairly touchy subject, and you have to be cognizant of not elevating the fact that you've put an ESG-oriented fund into your plan without elevating the other plans, the other funds in your plan. So just in closing comments, I know I'm up on time here. Really what we're aiming to do here is just provide to you as a listener and as a listener on this webinar, the why. Why is responsible investment important? Why does it make sense in this context? And then to wrap it up with saying, well, okay, now we understand the landscape. How do we really do this? And that's one of the core objectives of this initiative. We have some fantastic people working hard on this initiative. And I think we'll put together something really, really valuable for the listeners here as well as the broader audience.
Thank you very much, Will. Jim and Sarah and Mike, thank you guys all as well. And I'd like to turn it over to George for some Q&A.
Great. Yeah, thank you, everybody. There's a lot of great information, and we have some great questions on it. We have a few around the same theme of what are the barriers to doing more of this, both in terms of adding ESG options onto these platforms, but also in terms of encouraging more assets to actually flow into those options if they are in the platform. And so I think, yeah, if we can open up to anyone to address any of those.
Hey, so this is Jim Roach with Natixis. Maybe I'll address the second one. So assets, and Will and Sarah had great comments that there are a bunch of ESG options in plans. Some of the research we're seeing is that 7 out of every 10 new dollars in a defined contribution plan goes to the default, because plan sponsors, consultants like Mercer, they want to make it easy for the participants to invest, and a lot of people who aren't financial experts just go into the default, set it, forget it, and don't think about it. So some people are adding these individual 1 or 2 ESG options, but they're not being utilized because people don't understand how to use it. But if you have a default or a QDIA or an asset allocation portfolio that uses ESG, a pre-built package, I'd love to hear what Will and Sarah have to say, but I think you'd see a lot more pickup A lot more people want to invest this way. They're just afraid to. But if you give them these tools as the products have evolved, to let them set it, forget it with a glide path that de-risks over time, it makes it much easier for them to invest with their values and allow them to save for their retirement.
Yes, I agree with that. And I also think there's 3 other aspects of it as well. The first one being education, and really educating not only your participants, but also the investment offices on what ESG and sustainable investing is today, as opposed to maybe some of the myths that have been in place 10 years ago. And then also education down to the participant level. I think the other issue is fiduciary duty and performance. Am I going to sacrifice performance over the long term? And then the third issue, and we're seeing this with a lot of the retirement plans that we're having conversations with, is that ESG is an inherently personal issue, and it means something different to everybody. And it's how do you satisfy all the aspects of sustainability? How do you satisfy your entire retirement base across all the aspects of sustainability? So you have some people that really care about environmental issues, some people that really care about human rights, some people that care about safety. So education, and it's how do you satisfy that entire broad participant base when you're selecting a sustainable investment option for your platform?
If I can jump in as well, and thanks, Jim and Sarah. I think that's spot on from an advisory standpoint. The one thing that I would probably add is distinguishing between this idea of, and this is one of the things that we bring to our clients on a constant basis, is to say, well, you don't necessarily need to just pick an option. It's not that's not your end result. It's not only picking one option. One of the things that we bring as an idea to our plan sponsor clients is to say, well, you could consider constructing what we call a responsible investment tier. And so it could be a global equity, an active global equity strategy, a passive global equity strategy, and then, for example, a US fixed income strategy, which is commonplace within US defined contribution plans. So those are kind of 2 of your options. The last option is where I think we may see a lot of traction over the coming years, which is really this idea of ESG integration into a plan as a whole. So rather than picking and choosing the various kind of themes that you want to target within your defined contribution plan, one of the things that I think we'll begin seeing is utilizing ESG ratings, or really just understanding who are the highly rated ESG managers on average. And can we just incorporate this across our entire plan without sacrificing any sort of economic returns or financial returns, but really making this a widespread integration, as opposed to just this targeted, if you want it, here's a fund. What we'd love to do is just construct this across the entire plan, which to Jim's point would include at some point a target date fund as well.
Great, thank you. There's lots of great points to pick up on there, and they relate to a lot of our other questions. One of which is around what Jim was talking about around target date funds and the QDIA, which in terms of the lingo is the qualified default investment alternative. It's where money goes if someone doesn't pick exactly where they want it to go, essentially. And we had a couple questions around that. If that's the best way to encourage sustainable investment, it sounds like maybe from Jim's comments that is, but if others have thoughts on if that's the best way to do this. And also related, how to get boards comfortable with that in terms of having a strong ESG option as the QDIA.
I think that you'd be the best.
Yeah, I'm happy to take that. I think that one of the primary exercises that we undertake as a fiduciary extension, really, for our clients, is to say, here are basically the rules that you're governed by. Here's what you need to understand as it relates to your plan. And one of the primary features that we'll look at always is what Sarah just harped on, which is performance, and ensuring that when you're looking at these, at any sort of a potential fund for inclusion, whether it is a responsible investment intended fund or not, one of the things that we'll look at is performance and setting up a proper search. So basically saying, number one, identify your objectives. What are you really trying to do with this search? And what is the reason that you're performing this search for a new manager? And perhaps most importantly is when you get into the quantitative elements of a search, you're looking at a benchmark and you're looking at a peer universe to understand where does a certain fund lie within its benchmark and within its peer universe. At the end of the day, it should have basically either outperformed its benchmark and its peer universe over 3 and 5 years, if that's specified within the investment policy statement. But I think at the end of the day, what we're looking to do is align with that investment policy statement, ensure that we've documented the objectives for the search and what we're really trying to do, and then fulfill fiduciary duty by saying, we are looking into a fund that will be offered to our participants that does not sacrifice any sort of return. We have full faith in the manager, the strategy that they're running, and we appreciate the fact that they include ESG or non-financial material considerations into their investment process. So perhaps a long-winded way of saying, run the search like we would run any other search and ensure that it stacks up from a performance standpoint, and we're clear with our objectives for the search.
That process component is really key through all this. So I think we have time for one last quick one, and it relates, Sarah, to your kind of point one around the education on what is ESG, and also your third point on ESG being a personal issue. We've had a couple questions about, there's some SRI funds I see, and they've got some companies that I don't think are socially responsible at all. How is that the case, and how do we sort of, you know, different people may have different perspectives on that when you're dealing with a wide range of stakeholders. So this is a much bigger conversation around what is ESG is, but any just quick reflections to help people kind of think that through, and these options are in the plan, what that can mean, and maybe some comments on sort of the spectrum of what that can mean.
Yep, and I really think that goes back to the spectrum slide. So when you're talking about an ESG integrated, and if you add that across your platform, and as Will just mentioned, taking into account these risks and opportunities, you could end up with the Exxons in the world, and you'll end up with the ESG issues often manifesting themselves in position size, but it also, you may end up with these holdings in your account, but it takes in nothing that, you know, that engagement piece, really working with many of the companies to unlock longer term value for their clients. And also some of these are businesses that these companies can't just switch off. So if you look at like the utility sector in the US, many of these companies have legacy coal assets. We will stay invested with them as long as we are ensuring that they are on track and they're moving their business model to renewables, and they have high targets to get to renewables by whether that's a 2030 or a 2050 goal. So it's about engaging with those companies over time. And that's where this education piece comes into it, because it does mean something personal and something different to everybody.
Yeah, if I can add one thing, I agree completely with Sarah. It is education, and there are lots of different types of ESG. There are 5 different types of ESG, and one of them is best in class. So you will have some, it is an ESG product, but you will have some energy companies in there and some fossil fuels, but you're picking some of the best energy companies. And as I mentioned, we do many things, and but piggyback on what Sarah was saying, some of our, if you want to look in layman terms, are greener portfolios. We will own like a Next Era out of Juno Beach, Florida. They have coal mines, they have fossil fuels, but they're driving the change to renewable in the US, and we love that. So, you know, I'm probably gonna hit a hot topic and we're gonna end, but you know, we don't consider ourselves divestors. We consider ourselves investors. We invest the way we want to see the world over the next 5 to 10 years. And there has to be a couple energy companies in there. What they look like may not look like the other energy companies, but when we're investing for the world that we see we want to live in and where we think the winners are in the future, that plays a part in this. So investor versus divestor is a big important topic for us.
Great. Well, we are at time. And Sarah, Hannah, if you could pull the slides back up, we'll just wrap up. First, to say thank you so much to all of our panelists and presenters. As Chris mentioned, this is a subset of our sort of steering committee for this initiative. We do have additional webinars coming, so please continue to join us in these conversations. And if we just pop to the last slide to say, you know, as Chris mentioned at the top as well, if you or your institution is interested in these topics, learning more, helping us all sort of navigate how colleges and universities can move forward productively on this, please be in touch and look for ways to have you involved and keep you up to date on all of the activities around this topic. So thank you once again. Thank you all for joining us and have a great day.